So you're here to figure out the best crypto portfolio strategy for 2025. Smart move. With so many coins pumping and crashing, having a plan is more important than ever. In this video, we're going to walk through smart strategies for different portfolio sizes, whether you've got $1,000, $10,000, or even $100,000 to invest. We'll talk about how much to put into Bitcoin, Ethereum, where altcoins fit in, how to manage risk, and why timing your exit is just as important as your entry. By the end, you'll have a setup that helps you grow your crypto stack and protect your gains. To get us started, check out this page by Femex. It breaks down the 70-20-10 rule, which is a great foundation for any portfolio. So let's look into the backbone of the 70-20-10 rule. So as you can see, this article goes over various different things, like what a portfolio allocation is, the types of risks you should consider, what things are correlated, which assets are correlated with each other. And then it gets into a little bit of the breakdown of kind of how you should go about diversifying your crypto assets. Now, this article doesn't go into detail about the 70-20-10 rule, but it's a very common rule that is super powerful. Essentially, what it means is that you will put 70% of your money into the most trusted coins like Bitcoin and Ethereum. These are the giants of crypto. They've been around the longest, and they're the most likely to keep going strong even when the market gets shaky. Now, according to this article from Kiplinger and other professionals in the space, this chunk of your portfolio is your foundation. It's the part that you want to grow slowly and safely. All of this comes from a standpoint of risk. So the next 20% goes into your mid-size altcoins. These are projects with good potential, but a bit more risk. These might be coins like Solana or Avalanche. They can grow a bit faster than Bitcoin, but also bounce around more and have more risk, meaning they can go down much quicker. Following down the trend of increasing risk and minimizing the amount it is in your portfolio, we finally have 10% for what we call the wild cards. This is where you can take a shot at newer coins with very high upside, like meme coins, AI tokens, or gaming projects. As they explain on this SwiftX article, this part of your portfolio gives you a chance to catch massive gains, but you've got to be okay with taking some risk. Each of these parts of your portfolio plays a different role, and when they work together, it gives you a chance to grow your money while keeping your risk in check. So we've talked about how to split your money across different types of coin. Now let's look at something even more important. What are those coins actually doing? It's not just about picking random tokens. A strong portfolio spreads your money across different parts of the crypto world. This is often called sector diversification. According to this article by CoinRabbit, this includes areas like DeFi, which is like crypto banking, NFTs, gaming, AI, and even real world asset products. You can see more about this in their kind of section about different types of cryptocurrencies, where they talk about Bitcoin, Ethereum, Litecoin, stablecoins, and DeFi tokens. As I mentioned before, when you invest in multiple different sectors, you're not putting all your eggs in one basket. So for example, DeFi projects like Aave or Compound focus on lending and borrowing. Gaming coins might include projects like Beam or Gala. Then there are NFT-based platforms, smart contract blockchains like Solana or Avalanche, and brand new AI coins too. Each of these different sectors reacts differently when the market moves. The goal is to own a mix of these sectors so that if one goes down, the others might still be going up to kind of average out where your gains end up and kind of leave you staying strong. Diversifying like this keeps your portfolio safer and gives you more chances to hit big wins when certain trends take off. So now that we understand that it's important to build a well-diversified portfolio, it's time to learn how to protect it, because even the best picks can crash if you're not ready. In crypto, the market can drop fast, so risk management is a must. According to CryptoDesk, one of the smartest things you can do is use stop loss orders. They have other sections like understanding the crypto economy, diversification in general, security, risk tolerance and investment strategy, and then regulatory landscape. Within your investment strategy and risk tolerance is where the stop loss strategy resides, essentially. These are essentially when you set an automatic sell of your coin if it drops too far. Let's say you have a 10% risk tolerance, which is pretty low in the crypto world. I would probably want to set that up to maybe 20-30%, at least when you first start, and you can increase it over time as as your investment increases. But you'll set a maximum loss when you first start so that your coin will automatically sell so that it doesn't keep losing value and go even further than you'd like it to. This is important because crypto trades 24/7, so that way you don't wake up to a disaster one morning. There's another strategy called position sizing. Basically, don't throw too much money into one coin. This is kind of part of diversification. You want to take smaller bets, and the less that you can lose in one place means that you are diversified and kind of have a well-rounded portfolio. Coin Bureau recommends that you use stable coins like USDC or USDT as part of your portfolio. Think of these as your safety zone. They don't move with the market, they stay stable at typically $1. They're kind of pegged to the value of $1 for the most part. And these kind of protect your gains when things get crazy and also allow you to have funds readily available to make purchases on cryptos that go down and become in a good buying zone, or at least, based on what you might think might be a good buying zone. Another good tip is to always expect some drawdowns. As we've seen in the crypto market, especially lately, there have been weekly losses of even 15% or more. That's very normal in crypto, and it's why having a plan is key. If your portfolio drops and then you panic sell, you lock in your loss. But with good risk management, you'll be calm and prepared and ready for the rebound. So once your portfolio is all set up, let's say you use something like Coinbase or crypto.com, which I'll put links to below where you can get $50 worth of free crypto there. How are you going to keep track of it now that it's all set up? That's where portfolio tracking tools come in. They help you to see what's going up, see what's going down, and whether your plan is working. As you can see here, this platform Vestinda makes it super easy to monitor your coins, track profits and losses, and even automate some strategies. You can see what your total balance is, how each coin is performing, and make smart moves based on the real-time data. Over here on BlockPit, they also break down the top tools like CoinStats, Delta, and Kubera, all great options depending on what you need. The cool part is you don't have to guess. These tools all show you everything very clearly, so you're not just hoping that your crypto is doing well, you'll know. Okay, so once you've built your portfolio and started tracking it, what's gonna happen when things start moving really fast? Well, that's where rebalancing comes in. Rebalancing means checking in on your portfolio every so often and making sure your percentages are still where you want them. Let's say Bitcoin pumps and now it makes up 85% of your whole portfolio instead of 70%. Rebalancing would mean selling a little of that Bitcoin and putting that money into altcoins or stablecoins, just like you planned from the start. As you can see here on Reddit, people are sharing how they rebalance monthly or even quarterly, especially when one coin grows way more than the rest. This helps lock in your gains and then reduce risk by keeping the balance the same as you intended it. If you don't rebalance, you might end up way overexposed on a single coin, kind of like putting all of your eggs in one basket. To simplify, the goal of rebalancing is to stay in control. Crypto moves very fast, and rebalancing makes sure that your plan still fits your goals no matter what the market throws at you. Okay, so we've got our balanced portfolio and it's tracked, but what if you want to make it even smarter? Well, this is where AI steps in, which is a great thing that's happening in 2025. AI-powered tools are becoming a game changer in crypto investing, and according to DeFi Planet, as you can see right here, apps like TokenMetrics, Shrimpy, and Napkin Math AI help spot trends, suggest what coins to buy or sell, and even are helpful at building your portfolio based on your risk level. It's kind of like having a super smart assistant that watches the market 24/7 so you don't have to. So some of the tools here that you can see, you can search DeFi Planet for the best AI-powered tools, but some of them are Shrimpy, CoinStats, Kubera, Crypto Hopper, Altrady, I don't know if I'm pronouncing that right, and then they give pros and cons of each one here so you can determine which one is the right one for you. Some of these tools can scan thousands of tokens and find ones with strong momentum or low risk. Others can rebalance your portfolio automatically, so if one coin takes off or drops too hard, your plan can stay on track. You can even plug in your goals like wanting more Bitcoin by the end of the year, and the AI will aim you for that. In a very fast-moving market like crypto, these tools can help you move a lot faster, and smart choices without guessing are very important. It's not about replacing your plan, it's just about upgrading it. So now with your smart tools and your AI helping manage your portfolio, let's talk about one more thing: how to ride the waves of the market. Crypto doesn't move in a straight line, trends change very fast, and your portfolio has to change with them. According to this article from MoneyWeb, when Bitcoin dominance goes up, that usually means altcoins are struggling. Essentially, what Bitcoin dominance means is the ratio of the market cap of Bitcoin versus all of the other coins in the market. And a market cap is the price of a coin multiplied by the supply. So it's the total value of Bitcoin versus the total value of all the other coins in the market. Typically, when I like to see what's going on with Bitcoin dominance, I like to use CoinMarketCap. They have a great chart right here that tracks the overall dominance over time, and you can see kind of the convergence or divergence of that particular dominance. In this Medium article, they talk about how important it is to lock in your gains early. It's not about chasing the next 10x, it's really about knowing when to move out before the hype crashes. Rotating your money back into Bitcoin before the end of the bull run can protect your gains and set you up for long-term growth. The key here is to stay alert, read the trends, and don't hold blindly. Crypto rewards people that are smart and flexible, as well as being in the market longer. Okay, now that we've covered these smart strategies, let's see how this actually plays out with the numbers. We're getting to the real meat and potatoes here, the best part that you're really looking for. So let's say, for example, you have $10,000 to invest. You don't want to just throw that all into one coin and hope for the best. You want to plan. So according to uHolder and OBX, one of the best ways to set up a portfolio is to break it down by risk and potential return. So here's what that could look like. Let's say you have $10,000 to put in. We could start with something like the 70-20-10 rule and then modulate it from there based on our risk tolerance and how much we're willing to potentially lose for the sake of potentially even higher gains. So if we're gonna veer off a little bit from the 70-20-10, let's say we are a little bit more risk capable or up for handling risk. You'd start by putting, let's say 60%, let's say that's $6,000 into what we call blue chip coins like Bitcoin, Ethereum, and even Solana I would consider as a blue chip crypto. These are your long-term plays that give your portfolio lots of strength. Within that 60%, maybe we split it evenly. 2,000 in Bitcoin, 2,000 in Ethereum, 2,000 for Solana. I would probably weigh a little bit heavier into Bitcoin just to be a little bit more risk averse. Let's say 3,000, half of that 60% into Bitcoin, and then maybe 30% into Ethereum, and then 20% into Solana. So effectively that would be $3,000 into Bitcoin, $1,800 into Ethereum, and $1,200 into Solana. And basically you're decreasing your dollar amount by the more risky that it is. So these are your long-term plays that give your portfolio lots of strength. Now, instead of the 20% like the 70-20-10, we'll do 30% into mid-cap altcoins. These are promising projects in strong sectors like AI, gaming, and real-world assets, stuff like Render, Beam, or Ondo. There's tons of others, but these are definitely going to generate higher yield or have the potential to generate higher yield and higher returns. But of course, they're much more risky. If something particular happens in one of those sectors like gaming, AI, and so forth, they're going to be much more affected and their losses are potentially much higher. This leaves you with a remaining 10% for very high risk, high reward plays. So things like meme coins or early stage projects. I would probably aim more towards the early stage projects with actual functionality and practicality and value rather than just meme coins, but you do you. These could essentially 10x or crash completely. So keep the amount very small, very manageable, even decrease it from 10% to something like 5% or 2% of your total portfolio, depending on how risky it is. OBX has different profiles for crypto investor types, beginner, Bitcoin maximalist, trader, and so on. And there's a description for each, and it kind of will help you to determine where you actually stand on this spectrum and how to invest. So I definitely recommend you check out this blog post from them titled OBX's Guide to Building Your Crypto Portfolio in 2025. OBX definitely recommends adjusting your percentages of what you hold based on your risk level. If you're more conservative, shift towards Bitcoin. If you feel more bold, nudge up your altcoin bets. But either way, if you could take a look right here, they'll give you an example mix of each of your cryptos here, and this gives you room to grow while protecting you if things go south. So after walking you through all these portfolio strategies, you probably see it now. There's no perfect way to invest in crypto, but there is a smart way, and that's building a plan that mixes safely growth and flexibility. We talked about how to split your money between blue chip coins like Bitcoin and Ethereum, how to add mid caps and low caps for higher upside, and why rebalancing and managing risk is the key to not losing it all. I also showed you guys how tools like AI can help you with keeping it all in check. If you're ready to get started in crypto, I'll leave links to Coinbase and crypto.com where you can get $50 of free crypto just by signing up with those links. And if you want to get risky and buy some meme coins, I'll leave a link to MoonShot as well. If you sign up with that link and click the claim meme coins button, you'll get some free meme coins just for signing up. If you enjoyed this video and learned something, make sure to drop a like and subscribe to stay tuned to all things crypto. I'll catch you in the next one.